So what's behind the sharp rise in the world markets in the past 2 months? Here to help us make sense of all of it is John Authers, the investment editor of the Financial Times. Good to have you back.
Glad to be here.
So the markets did well today. They've actually done well for the past 2 months. What's behind the surge, and does it mean that the worst is behind us?
Well, it doesn't mean that necessarily yet. You have to remember where we started. Back in March, stocks had fallen more than 50% from their highs, very much more in some cases, and pessimism was really in the ascendant. Greed was completely vanquished by fear, and those are the classic times when you can get a stock market bounce. You know, the classic trader's phrase is even a dead cat will bounce if you drop it far enough. So it's not surprising that you see a trading bounce. Add to that, there is substantive news from China. Obviously, statistics coming out of China, a very difficult country to measure, are always subject to some kind of question, but it really does look as though China is finding ways to keep growing, which people did doubt a few months ago. You're seeing exports of the main countries that export to China beginning to pick up. And so you do have some confidence that China, if not the US, is going to keep the world economy going.
Well, let me mention some other positives on the international side of things. Consumer spending, home refinancing and lending, all of them indications that there are positive changes occurring. So does this mean the global economy is on the mend?
I don't think we can say that with any clarity. What perhaps you can say, and which does at least help for the markets, if not for individuals hoping to hold on to their jobs, is that the rate of decline, that kind of free fall in industrial output and in demand that we saw in the first few months after the Lehman bankruptcy, that great shock that hit everybody, that free fall is definitely over. We're now in much more normal conditions, much more like what you see during a normal bad recession as opposed to the depression that people were worried about a few months ago. That, at least for the stock market, is good enough news to stage a rally.
Let's look ahead of the stress tests expected to come out later this week. Do you think the markets have anticipated these, or could there be some shock?
Well, plainly, there's always a capacity for shock coming out of the US banking system because we've had any number of surprises from the US banks in the last 2 years. The stock market wouldn't be behaving like this if it didn't think it was going to be manageable. The one great concern I would mention is that the credit market, if you're a relatively high-risk credit trying to borrow, it's still very, very expensive to do so. That shows the credit market is still worried. But certainly overall, the market seems to be thinking that these stress tests are going to be manageable.
John Authers, thank you very much.
Well, thank you.